Okay, so being profitable is pretty much pointless for modern companies. The big shots running things don't care about profits, the investors don't care about profits, and even the people working there couldn't care less about profits these days. That's why we're seeing all these big companies losing tons of money lately. Zillow? Lost $101 million last year. WeWork? Lost $2.7 billion. Snapchat? Down $1.43 billion. Uber? A whopping $9.1 billion gone. Back in the day, that kind of loss would have been a total nightmare for the owners. They would have been sweating bullets about the possibility of bankruptcy if things didn't turn around soon. But now, it's like nobody cares. This is the circle future. All that matters these days is growth, growth, growth. As long as the company is showing some kind of growth, nobody cares if they're losing money. And it's not just the little startups doing this. Even the big tech giants have been following this strategy for years now. Amazon has always been right on the edge of profitability. Their retail business still isn't profitable to this day. Same goes for Google. They're making bank with their ad business, but pretty much everything else they're doing is taking a loss. Last quarter, their cloud business lost $480 million. And let's not even get started on Facebook and their whole metaverse thing. Even some of the more old-school companies are getting in on the action. Look at Disney. They're still making a profit overall, but they're definitely using this new approach for things like Disney+. Despite having hundreds of millions of subscribers, they lost $1.5 billion in just the last quarter. It's not like these companies are being forced to lose money. Most of them could easily raise prices, cut back on marketing, and stop investing so much in new stuff if they wanted to start making a profit again. But they don't want to. They have the money to burn, and they honestly think it's the better long-term play. But it wasn't always like this. Back in the day, profits were everything. The owners needed those profits to pay themselves and their employees, and to give bonuses and other sweet perks to the shareholders. So no matter what kind of business you were running, from oil to steel, you wanted to start making a profit as soon as possible. But over time, that sense of urgency just kind of faded away. Instead of needing to reach profitability within a few months or even a year, owners started thinking in terms of 2, 5, or even 10-year timelines. And now, it seems like the goal is just to keep growing forever, no matter what. So that's how we got to this point where pretty much everyone involved in a company is just okay with losing money indefinitely. Accepting losses might seem like a new thing, but it's actually been around for a while. We can trace it back to World War I, when everyone was expected to pitch in and help out. This included companies and their big-shot executives who were major players in production, logistics, and contractor deals. Unfortunately, the government couldn't legally accept these services for free. They didn't want to pay these execs a lot of money because they were already loaded, so they decided to pay them $1 instead. This practice became super popular during World War II, with big names like William Knudsen joining in on the $1 service. After the war ended, the $1 salary trend faded away until the 1970s. The auto industry was struggling, and Chrysler was in dire need of a bailout. So, to show that he meant business, CEO Lee Iacocca offered to take a $1 salary. This move helped turn the company around, but people were more focused on his tiny salary than his big success. Back in the 70s and 80s, taxes were a real pain. If you made more than $215,000 a year, you had to pay a ridiculous 70% income tax. Long-term capital gains tax was way more reasonable at 28%, so founders started to lean more towards stock compensation than cash compensation. Eventually, Steve Jobs took this even further and accepted a $1 salary when he returned to Apple in the 90s. He wasn't doing this to save money on taxes or earn more stock compensation. He just wanted to show that he was there for the company, not the cash. Other CEOs saw how smart this move was and quickly followed suit. It was a win-win-win-win situation: less public backlash, bigger stock compensation, less tax, and higher stock prices. Of course, they still had to make sure the company was making bank, but that was changing too because shareholders were starting to demand more. Back in the day, one of the coolest things about stocks was their dividend. You felt like you were part of the company, getting a cut of the profits every quarter. That's why traditional companies like Exxon and Coca-Cola are all about those dividend payments. Exxon has been dishing out dividends for over a century, and they didn't even miss one payment. Historically, dividends were the thing that drew investors, like Warren Buffett, to a stock. So, for those companies, keeping the dividend reputation squeaky clean was a big deal. For some stocks, the dividend was the main source of their return. Steel companies and insurance companies weren't doubling in value every year. They were growing at a more reasonable rate, like 5 to 10% over a few decades. So, that dividend was what made stocks like AT&T, which hasn't really budged in almost 30 years, worth having. But then the internet came along and changed everything. Suddenly, companies were growing like crazy, some at 100% every year for a decade. And the company that really drove this home was Amazon. Now, Amazon's retail business wasn't exactly raking it in, but they found a goldmine in Amazon Web Services. Jeff Bezos could have just focused on AWS, jacked up the price of Prime a bit, and started paying out sweet dividends. But that wasn't his jam. Jeff was all about the stock, not the bottom line, and he wanted investors to feel the same. Luckily for him, a new breed of investors called growth investors were on board. They didn't care about dividends and thought they were a total waste of money because of taxes. You see, dividends are taxed twice, once by the company and then by the investor. If Amazon paid out $1 in dividends, they'd have to pay about 25% in corporate tax first. That means only 75 cents would actually make it to the investor. Then, the investor would have to pay personal income tax on that 75 cents. And since most of these investors have a decent chunk of change, they're paying around 40% of that dividend in taxes. That leaves them with a measly 45 cents. Plus, a lot of these investors want to reinvest the dividends anyway, so it makes no sense for Amazon to pay out a dividend only to have the government take 55% and then get 45% back. Instead, Amazon can just reinvest all of their profits, and that's exactly what they've been doing. For a while, value investors were hating on Amazon and these growth investors, but over the past decade, growth stocks have taken over the market. Most of the big tech companies don't really pay out dividends, and all of the returns for investors come from growth. And even Warren Buffett decided to invest in Amazon, so you know it's legit. The only group left to join in on the fun? The employees. Employees have historically preferred profitable companies, much like shareholders. Joining a company is not just an investment for employees, it's their livelihood. Traditionally, employees used to stick around at the same company for their entire careers, so choosing a stable company with large profit margins was essential. But over time, employees have become more and more risk tolerant. Today, employees no longer feel tied down to one company. In fact, they've realized that their peers who constantly switch companies tend to earn a lot more money. So now they're more likely to join a startup or a company that's trying to stage a turnaround. If it doesn't work out, they can just find another job. If it does work out, they become a key member at this new company, maybe even an executive. What's more, employees today are more willing to take stock compensation, which they used to refuse because it's riskier. They're also more aware of how the wealthy make their money, and they recognize that to become truly wealthy, they need to own assets like real estate and stock. As a result, more and more employees have started asking for stock compensation. For companies, it's a win-win situation. It's easier to pay stock compensation than cash compensation, which is the main reason compensation at big tech companies is so high. The best part for companies is that they don't even have to convince employees to take stock compensation, employees are literally asking for it. And with that, the last domino has fallen. Okay, so here's the deal, companies still want to make money, but they're way more chill about taking in loss than they used to be. If there's more room for growth, companies are down to keep running at break-even for the foreseeable future. Take Salesforce for example, their revenue goes up every year, but their net income is pretty small compared to that. And it's not just them, Shopify, Amazon, Uber, Airbnb, Zillow, you name it, they're all cool with not making a profit as long as they're growing. It's a win-win for everyone involved. No profit means no taxes cutting into the cash flow, so everything can be reinvested to keep the growth train chugging along. Sure, some of these companies are starting to realize that infinite growth isn't really possible, but that's a whole other story. If you were the boss of a company, what would be your priority, making bank or growing like crazy? Let us know in the comments. And if you want to see more videos like this, hit that like button.